Morning from London. This is Bloomberg Markets Today. I'm Guy Johnson alongside Kriti Gupta. We've got less than an hour away from equity trading here in Europe. So what do you need to know this Monday morning? Political risk reigning over markets this week. The first round of the French election less than a week away. The first presidential debate in America is this Thursday. The EU and China agree to talks on EV tariffs. Germany's Vice Chancellor Robert Habeck wrapping his trip to Beijing. We're going to have the latest on all of that. And Bloomberg hosts the 2024 UK election business debate. Full coverage at 12:30 as Anna Edwards moderates the Conservative Kimi Badenock and Labour's Jonathan Reynolds. Kriti.
In the meantime, a quick check on these markets. A little bit of a mixed picture when you look at futures pricing here. Euro Stoxx 50 futures really flat. FTSE 100 underperforming by 0.1%. Actions in the currency space. Euro dollar 106.98. Cable at 126.46. Markets today starts right now.
Monday the 24th, good morning. We have a busy week coming up. We've got lots to debate. It is going to be dominated by politics. There are other things going on. You've got Fashion Week in France. You've got a bit of data coming out Friday on the inflation front out of the United States, Kriti. But it really is the politics that is going to be dominating. French politics, UK politics, US politics, EU politics as well. All of that coming up throughout the week. And I suspect that that is what the markets are going to be on tenterhooks regarding.
They're going to be on tenterhooks, but are they going to be able to price it in? What is the trade? And that seems to be the question that everyone's asking because the path forward is unstable. It's a little bit doomsday-ish, I have to say. When it comes to EU, I'm glad that you mentioned that as well. Ursula von der Leyen expected to begin her second term as well, but that's still to be confirmed is my understanding of that. In addition, of course, to your point of the ramp-ups with the other 3 elections around the world.
Absolutely. Let's talk France first, though, because I suspect that that is the one that's going to really set the tone, though I am fascinated by the US debate Thursday.
We appreciate that.
And I know you want to talk about that. So let's talk about France. Marine Le Pen, the latest polling, and we're going to have a poll of polls out in around 30 minutes' time, but the latest polling I saw last night seems to indicate that she is moving further ahead. They're not there yet on getting a full majority, but they're getting closer and closer.
They're getting closer and closer, and so is the left, by the way. It's still polling way ahead Emmanuel Macron as well. You are seeing the market basically saying, if you look at the kind of commentary over the weekend, saying that's actually your worst-case scenario, given some of the kind of turn back and the repeals, I would say, of a lot of the pro-business reforms that have hit the France in the last couple of years. In addition to the spending capacity. I think that's where the spending story really freaks markets out the most on both sides, with the right and the left. I think Allianz came out with some research over the weekend as well, saying that your worst case scenario from a yields perspective comes if either party starts to spend more.
Absolutely. Most elections, you get to the election, you get the results, and you can price in certainty because you've got a clear idea, to your point, about what is likely to happen. This one feels different. Like it feels like there's going to be a hangover here in a way that you don't normally get. So the markets are really going to struggle with this one, I think, just to understand what the implications are. There's going to be a lot of horse trading. There's going to be a lot of detail still to be decided. So we think we're going to get kind of through this in the next couple of weeks. I'm not sure that we are. I think this is going to have a long tail to it.
It's going to have a long tail to it. I think the united front from an EU perspective is crucial as well, because not only do you have this kind of, we had the EU elections, but you have a lot of, I want to say, I don't want to say anger. I think anger is the wrong word, but a lot of concern from Giorgia Meloni's government in particular.
I think anger's not too far away,
but close enough, perhaps. At the same time, you have France and Germany, of course, not seeing eye to eye on a variety of different factors. Specifically, if France has more of a leftist government or more right government, their changes or their policy on things like minimum wage or taxes, et cetera, really divides them or pushes them away from the broader EU stance. Then you've got the China question as well. There's a lot of several layers here.
Let's just deal with Meloni for a moment. The Meloni question, she's really, I think anger is probably the right word to use. She is feeling that she's been left out. She's feeling that there's a stitch-up around the key jobs. She feels that her bloc does have the necessary votes to assume one of those jobs, the kind of big sort of 3 commission jobs. So this Thursday's meeting with EU leaders, I think, is going to be fascinating to see how she handles it. You then put the potential for Le Pen and Meloni. Now, they're not seeing eye to eye at the moment, but you put them on the same page. life gets really interesting.
Interesting is a key word. But again, bringing it back to the markets, how do you price in something like that? How does that show up in the policy framework and then into the economic framework?
I think you basically sell first or buy first, then you ask questions later.
Yeah.
I think that seems to be the narrative at the moment. The level of uncertainty is so high that the market is not prepared to take the risk. Yeah. Should we talk about the US?
Let's.
Wow, that's going to be a big event, isn't it? I think massive market potential implications here as well. What's going to be said on China? What's going to be said on spending between these two candidates? I think the market really needs to pay attention to that.
Before we talk about the U.S., let's talk about Germany very quickly as well, because China. Come on, guys.
Sorry.
But it all connects.
I'm getting
right?
ahead of myself.
You're getting so excited, but it all connects here because at the same time, China seems to be such a big part of the question. Remember, the EV tariffs were something that Germany wasn't so thrilled about to begin with. Then you have Robert Habeck.
I could be wrong.
We don't know. The economy minister of Germany visiting China as well and really kind of trying to smooth over relations. And I think this is important because this is the second and third largest economies in the world. China is Germany's largest trading partner. Germany is France's largest trading partner. There is a ripple effect that you are going to see, and they're kind of smoothing this relationship over to the point that now there's going to be a dialogue on those EV tariffs as opposed to simply imposing them directly. And I think that's going to be another piece that is likely going to show up in the U.S. debate as well. How do you tackle the China question at a time when, well, the economy is still rolling, there's plenty of investment, but that could all turn on a dime come January 2025.
Craig Trudell's going to join us a little bit later. We'll get more detail on what's happening with that terror story. I think it is fascinating that the EU is getting on the same page. Dombrovskis is sorting that one out Saturday. The Habeck thing, I think, is interesting as well. Also, there's a Latin American angle on all of this as well, which you want to flag too, which I think is kind of brings us back to the trade story in bigger picture.
Well, it's this fragmentation, this deglobalization theme that you are seeing around the world. And I think a lot of it comes from the U.S. in particular, which is saying, look, we're going to bring a lot of this globalization of the last couple of years in-house, whether it comes to the chip sector, whether it comes to the defense sector, regardless of what you're manufacturing, we want to bring it onto our shores. And that's a theme that you were seeing around the world. What do you do in response to that? Well, the EU has said, well, we're going to find other parts of the world to partner with. And a big part of that is dealing with South America. China has talked about this as well. What kind of raw materials can you get from the likes of from Chile, from Argentina, from Brazil, et cetera? Copper is a big part of that story. Lithium is a big part of that story as well in terms of the EV transition. Now we're talking about this potential trade deal. It would be about, I think, 750 million customers, consumers in between the EU and South America, or at least the trade pact. And yet France is pushing back.
Can we talk about the US now?
Yes. You got that out of the way? Go ahead.
Yeah, okay.
say what you're really thinking, guy. Hit me.
I think it's all connected. I think the connective tissue here is the relationships, the joining of the dots between all these stories, I think is part of the bigger picture that I think investors need to see right now. I think the US debate does fit into this. China's going to be front and center. What does the US do next with China, I think, is going to be really interesting. What does the spending story look like going forward? Do we see an extension of programs like the IRA, in terms of the US industrial policy? All of this, I think, will get some clarity. Let's hope we get some clarity Thursday.
Well, of course, you mentioned the tariff story. That's going to be huge.
Yep.
I'm glad you mentioned the spending story because you talk about the IRA, which, of course, Emmanuel Macron has been very vocal against it in terms of creating subsidies that bring a lot of investment to the States. The UK is a big part of that as well. The UK defense companies getting an exception, by the way, under the IRA in a way that the rest of Europe and arguably the rest of the world is not. That's a really big story as well. The deficit is what concerns me. We've been talking about it over and over again in terms of France, in terms of the UK. There is no spending ability. There's no spending ability in the States either. It's the first thing on the new president's docket, whoever that may be, in January 2025. And we still don't have clarity on where that's coming from. Even if you have spending cuts, it's still not enough to not hit that red wire, red tape, whatever.
Red line.
Red line.
Go over the red line. Red wire might be more effective.
Over the cliff.
You're going to trip over it. Back to the markets. I think the relationship here is with the bond market. So does that mean you have longer term 10 years, 20 years, 30-year bonds? Are they going to be higher in terms of the yield that they're demanding? And also, there's a lot going on at the front end of the curve. The US is funding a lot of this with short-term bills at the moment, which is causing concern around the QT program. It's causing concern around the money markets as well. So this is highly relevant to where yields and positioning is right now. It's
highly relevant. What I'm waiting for is the contagion effect, though, right? I'm waiting for this kind of turmoil you're seeing in France, this potentially Liz Truss 2.0 that everyone's talking about, to show up in the Treasury market, and it's not.
You guys are exceptional.
Thank you. I take personal responsibility for that. But I think it's important because when you saw it happen in the gilt market, it did have a direct read-through. you're seeing it in the U.S. story, or you're not seeing it in the U.S. story, and I'm wondering how much of that is dislocation. I think it might even show up more in the FX market when suddenly you're talking about the potential for parity now if you continue to see this weakness.
Keep an eye on the dollar this week. Actually, that is one. You're absolutely right. That is one of the key trades I think to watch out for this week is how the dollar is going to work its way through all of this.
Yeah.
Are we going to continue to see some of this strength? You could argue that, particularly with the French politics, that's where it's going to show up the most. And I think if you get EU political sort of divisions as well this week, that could factor into that story as well.
And I think the other piece of this as well is we're talking a lot about the geopolitics and the policy story. We're still in an economic kind of landscape where specifically when you look at the potential for euro-dollar parity driven by that widening spread between the French and German debt, you are always going to see real weakness, real manufacturing weakness in Germany that's sustaining, manufacturing weakness in the States as well that is continuing, even though it's not as big a part of the economy as Germany's is as well. There's an economic story that all factors into this. The minute you have any sort of more overt slowdown, more overt signals on monetary policy, how do you factor in the fiscal?
I can't believe we got through an entire conversation thus far without talking about the fact we've got inflation data Friday, which is going to be interesting too. Will that signal September? I think that is what the market is on edge, looking to see what that data tells us. We actually got EFO on Germany today, so I think that's going to be interesting in the light of the PMI. So there's some data throwing. Got the Riksbank Thursday as well. French Fashion Week. That's
the highlight
my
for
favourite
you.
subject. Let's talk about haute couture.
Maybe they can get you some more ties. You can see what ties are showing on the runway.
Ties. Talking of ties, let's tie it back to UK politics and talk about what is happening. Back to the politics. Anna's got a big day today, 12:30. She's going to be debating. She's going to be moderating the debate. Jonathan Reynolds, Kimi Badenock, the business secretaries. What does British business want to get out of this election? I think a number of different things. And some of it came out over the weekend, this kind of what is going on with the Labour Party in terms of rejoining the customs union, potentially the single market. I think key subjects, what happens on taxation. There's lots of things for Anna to go out here.
Is that being taken seriously, though? I mean, it's been in the narrative.
Debate? Yeah, very.
No, the debate is 100% being taken seriously. The conversation around potentially these kind of more pro-European, more friendly towards Europe conversations, how do you price that in? Is that even on
Well, I think you price it in with a stronger pound. And maybe there's some evidence of that already. Yeah. So I do wonder whether rejoining the customs union, is that a first term or a second term? Is Labour trying to figure out how to win two terms here? How does it deal with taxation? I think all of that at the moment is up for grabs. But the UK has been completely overshadowed at the moment by what is happening elsewhere. The French story is that has real long-lasting implications for how Europe goes kind of into the next era and deals with the United States that's getting more protectionist and the China that's getting more protectionist.
I love that. I think we had an FX guest on last week, and the name escapes me, but who had said that the pound is now serving as some sort of haven, some sort of local safe haven, which is not something I usually associate with the pound, and yet you are, to your point, continuing to see that strength. I think 126 on the pound, and a lot of that isn't even a function of what's going on in the UK. It's a function of what's going on with the chaos in the rest of the world.
Absolutely. It's a novel and new experience for many people here in the UK. Anyway, so Anna's got a big day. It's coming up a little bit later on. You are definitely going to want to tune into this. You can find it across the Bloomberg sort of functions. Bloomberg's live televised debate, 12:30 p.m. UK time. The Conservatives, Kimi Badenock, Labour's Jonathan Reynolds, Anna Edwards. It is necessary viewing today. Bloomberg Television, you can find it there on the terminal, on YouTube, on radio, etc., etc., etc. We're also going to be catching up just before the debate with Philip Hammond. He, of course, is the former UK Chancellor. He will be joining the Pulse. That conversation is at 9:30 a.m. here in London.
Coming up on the program, we're out to Beijing for more on China's potential talks with the EU over EV tariffs as Germany's Habeck continues his visit. Plus, over in the States, U.S. data this week giving markets and the dollar clues on what the Fed may be thinking. Up next, however, President Emmanuel Macron behind in the polls. We'll discuss how traders are bracing for next week's French elections. If you have any questions of your own for our guests, please send them to us on IB plus BBTV Go. Get involved in the conversation. We'd love to hear from you. This is Bloomberg.
I hope that parties that are not Le Pen, to put it that way, are successful in the election. But that is for the French people to decide.
The The German Chancellor Olaf Scholz wading into French politics over the weekend is going to have such an impact in Germany as well. What happens next in France? So we need to figure out what the latest looks like and how the landscape is evolving. The polling pointing to the fact that Marine Le Pen's party is increasing its lead. It looks like we're going to have the far right, the far left in the second round. That is certainly what the polling points to. As I say, we will have a poll of polls out in around 12 minutes' time here at Bloomberg. We'll bring that straight to you. Let's go to Paris. Anna Boata, head of economic research at Allianz Trade, joins us now to give us a take. Anna, that's what it looks like. That's what we're heading for. Walk me through how you think markets should be reacting to what we're seeing here right now. Is there any kind of clarity in the confusion that you're seeing at the moment?
Well, what we know is that, of course, we have a high probability of these alternative negative scenarios to materialize. And we have seen that markets start to be worried. The French spread to the German Bund, it's already at 75 basis points, right? But it can go further high because we see that the electoral pledges of both far right or far left are evolving. So they do backtrack on some of their pledges, but we do still see fiscal slippage ahead. If I give you some numbers, right, if we think about the Marine Le Pen alliance, they were starting at 125 billion euro of program. They backtracked to 75 billion euro, but they still have a slippage of around 25 billion euro. Now, if we go to the Front Populaire, to the far left or the left alliance, of course, we do talk at the starting point at 125 billion euro. They backtracked from 142 billion euro, and we will need to see, but the fiscal slippage is the double of the far right, so around 50 billion euro. So whatever you look for, you will either end up in 2025 with a fiscal deficit of close to 5% of GDP or to close to 6% of GDP. Of course, we don't start from a very good point, right? Because we already start at 5% of GDP of fiscal deficit. But if we want to correct the fiscal and public finances, we will need to correct by at least 1% of GDP per year. If we look at what we need in terms of primary fiscal balance in order to stabilize the French public debt, we do talk about a surplus of 1.5% of GDP. And we are now at a deficit of more than 3%. So, of course, the markets are scrutinizing that. And I think the only thing that saves us from even further volatility and market correction is the fact that everyone expects the ECB to jump in through the TPI program. And for now, we don't even know how this program works. We do understand that the ECB is ready to activate this program. But if we have a very large and let's say aggressive contagion to the rest of the Eurozone. So that's still something to be seen. And if we think about the holdings of the ECB of French, for example, corporates, we do talk about 25 to 30%. So we understand that there will probably be a need for the ECB to jump in.
Wow, we're already there. That's amazing that conversation is already starting. The fact that we're kind of already talking about the idea that the ECB will need to take some sort of action. Let me throw another scenario in, and that is neither the right nor the left win. What does that scenario look like from a market perspective?
Well, if let's imagine that we do have a center majority or minority, rather a center minority program or government, we would probably end up with spreads at 60 basis points. So the spreads will backtrack, which is half of what we would see if a majority left is winning, or 30 basis points lower than what the far right majority would mean. We will probably not see any adjustments in equity markets, not downside adjustments compared to minus 6% or minus 12%. So you see that we are from simple to double when we look at the corrections. When we look at corporate spreads as well, we would be above 250 basis points in the worst case scenario. So in a way, it brings us back to 2018 in Italy, right? When Salvini was winning the elections and the spreads doubled. And I think this is something not to forget, because we tend to compare France with Italy today, but that's not the same situation. And I think that's something to clearly not to underestimate as a potential scenario. Now, of course, the uncertainty will not stop on July 7th. We do know that there are certain constitutional powers also in France, also for the President Macron, and we do know that some could be triggered, including potentially another round of snap elections 1 year after. So a lot will still come from France, but of course, in a period where France is in the spotlight, not because of the elections only, but also because of the fiscal rules, right? We do know that France is now on the verge to be on excessive deficit procedure. Not alone, of course, but France doesn't have the leeway that Italy has today in terms of additional potential growth from next generation new funds. So that's clearly something also to be taken into account, because we do miss around 3% of GDP of potentially higher growth in the next 2 years. And that's clearly, in terms of fiscal adjustment, that France needs much more than what Italy would need. And the markets know that.
Well, Anna, to your point about the fiscal deficit, what is the key fiscal policy that perhaps markets and economists are going to be most sensitive to? There's a lot in here on all the various agendas and economic policies that are coming up. Things like hiking taxes, increasing the minimum wage, more spending on defense, whatever that may be. What is the most susceptible to accelerating that deficit?
Well, we do have a number of additional spending. If we think about the far left, or if we think about the far right, it's a lot of social spending. It's compensated by higher taxes on wealth, higher taxes on super profits. So clearly, that's a, let's say that's a policy that would reduce France's attractiveness in terms of foreign investments. And we do know that France was taking off when it comes to its attractiveness for foreign investment. And if we think about the minimum wage, that it's not only, for example, from the far left, right, plus 14%, it's not only France, because even the UK has increased it massively, and it will continue to do so under a Labour government. But it is clearly reducing any leeway that companies might have in terms of profitability. And actually, French corporates are not very profitable in general. They are quite indebted, low profitability. So clearly, we do have a different situation, again, from other markets. So I think markets will really look at, not necessarily at a lot of specific policies in place, of course, those that will hamper French competitiveness and attractiveness, or maybe even hamper any kind of wealth, right? Or even direct some of the French savings into French bonds, for example. We could even think of those policies, right? Just to finance the public deficit, like it's the case also in Italy. But they will look at the fiscal slippage. And this is what we learned from the UK under the Truss government, right? We do understand that the markets want a compensation in front of this additional spending, because additional spending at the end of the day can support growth, right? But we also know that it will take time to implement them. So growth will take time before it's seen. And in the first place, we'll have negative confidence effect, tighter fiscal conditions. So clearly, at the end of the day, we will not end up in recession. Either we're far right or we're far left, but we'll end up with growth below 1%. And the markets know that this growth is not enough to mechanically, if you want, improve French fiscal deficit. So clearly, that's a bit the thinking behind. The specifics of the reforms, in any case, what they tell us today would not be what will be implemented tomorrow. And I think this is probably the wait-and-see mode of the markets currently. They just wait to see what other electoral pledges might be backed down in the coming weeks.
All right. Anna Boata, Head of Economic Research over at Allianz, we thank you so much for joining the program. Guy, this is a really crucial point that she's comparing Italy, she's comparing the UK in terms of what the read-through actually is. Do we have a roadmap, a historical roadmap that we can kind of map things out with?
I think you can amalgamate various different things together and kind of put them into the French scenario and try and figure it out. But I think we are, to a certain extent, in uncharted territory, for France at least, and also the implications for the rest of Europe. We're trading 79, 78 over Germany this morning. That could go much higher.
It could, especially with the German weakness. More on how that all translates into the FX space. That conversation next. This is Bloomberg.
I do think that if you think about the increasing risks for the medium term, euro sterling is a key cross we're looking at. The other currency that benefits is the Swiss franc, obviously, in this situation. It's the typical place where Europeans, use as a safe haven. In contrast, this entire geopolitical situation hurts Central and Eastern European currencies.
Tamos Viotakis, head of FX research over at Barclays CIB, walking us through what the trade may actually be off the European story. Euro dollar at 107.04 at the moment. Does it stay there? Joining us now for more insight, Charu Chanana, head of FX strategy over at Saxo Markets, joins us this morning. Charu, pleasure to have you on the program. Seeing slight, and big emphasis on the word slight, strength in the euro this morning. But I'm curious about this downward pressure theme that we've been hearing. Naturally, with geopolitical turmoil that we see on the continent, we're going to see some weakness in the euro. How far does that weakness go?
Hi, Kriti, and hi, Guy. Thank you for having me. Certainly, it looks like the pressure is piling on euro, not just from the geopolitics side, but also from the macroeconomics side, especially if you look at those PMI numbers we got on Friday. It seems like certainly that ECB is turning a little bit neutral at this point, but how far can they delay that continuation of the rate cut cycle has been brought into question with that disappointment coming through in the PMI numbers. But yeah, back to your point on election jitters, that certainly seems to be the theme for this week as we head into those France elections at the end of the week. And that uncertainty is unlikely to go away, at least until that first round of elections is over. So from a very tactical perspective, I'm looking for euro to, first, tend to that support at 106.75 level. And once that breaks, I think the downside momentum could really pick up from there. And the next level to watch at that point will be 106.20 or even the psychological 106 level.
Well, Charu, a lot of focus has been put on the euro tracking, of course, naturally, the spread between French and German debt. The French yields, of course, skyrocketing off of the turmoil. But I think a lot of folks are forgetting that the German debt is also, or the yield on the German debt is also dropping as well, partially because of that safe haven bid, but also partially because of the weakness you're seeing in the German manufacturing picture. How much of the eco is being overshadowed by the geopolitical right now?
I would say certainly, I think eco is playing a huge part. But when we talk about Europe in particular, and specifically after those European parliamentary elections, risks have been skewed a little bit more towards the geopolitical side. Also because, like I said, the ECB is starting to look like they may hold off on rate cuts further as long as we don't see further disappointment in data. We've seen, that kind of putting a brake on in the FX markets, particularly on that central bank divergence narrative. As much as we've seen the SNB still continuing to cut rates, I think that is also a factor that the safe haven bid now in Europe particularly is actually turning more towards sterling. And again, euro does not come into the picture again from that respect. But unless we see more, activity on macroeconomic surprises, I think which is unlikely in this summer months when the volatility is likely to remain pretty low, I think the focus will potentially stay more so on the election risk. Now we are also heading into that US presidential election debate. And again, what that means for China tariffs. And, again, euro comes in the picture on that front as well.
Charu, good morning. It's Guy. Can I use the dollar as a safe haven there for this week, given that debate and that debate's potential to upset a number of different aspects of global trade, geopolitical relationships, and US spending? Can I go into does the dollar win regardless kind of whether or not that event creates volatility or doesn't create volatility?
I would say actually that would potentially remain the base case, because from what the markets are positioned for at this point, in terms of both the macroeconomic cycle as well as that presidential debate is, a longer, higher for longer kind of a narrative from the Fed. And if at all we were to see Biden being reelected, then the policy stance remains more or less the same. But the real risk for the markets is really if we do see that uptick in the possibility of another Trump presidency. And with that, the first focus shift will come towards the risks of tariffs. I think in terms of fiscal policy, there will potentially not be a huge difference between what we get from the two different administrations. So tariff policies are really the discriminating factor here. And given that tariffs could be inflationary, certainly that means that the US dollar remains, potentially a safety haven as well as an inflationary haven in this regard.
So the dollar's a safe haven, the pound's a safe haven. Let's just talk a little bit more about the pound. If the Labour government decides that it wants to take a much more positive stance, or a significantly more positive stance towards Europe, and the language changes at the beginning, potentially, of the next government, what's that worth in sterling?
I think that could bring some near-term upside, but again, I don't see that being a game changer in the medium term, because the focus after the elections is likely going to shift back towards the macroeconomic headwinds that UK is facing, with unemployment still rising, wages still continuing to exert that upside pressure on inflation, and at this time, the Bank of England again signaling rate cuts as well. These relationships between UK and EU certainly look like they will be in a better position if we get that Labour majority. But this is a long-term story. I don't think the relationship would be, restored by the end of this year or anything. So that is certainly something that the sterling will come back to focus on once we get the start of the BOE and potentially the Fed rate cut cycle as well.
Well, Charu, to your point, how quickly, or I guess what is the reaction function for some of these central banks, as you mentioned, to then digest and react to the fiscal? And specifically when it comes to what you're seeing in France, is this a 12-month out story, or do you see some sort of repricing for ECB cuts specifically, or even Fed cuts, based on what happens July 7th or July 8th out of France?
I would say most central banks are quite confused about the economic trajectories at this point. It seems like there are some sections of the economy, particularly if I talk about US, but also in a broad sense in Europe as well, that are coming under pressure because of these sustained levels of high interest rates. But certainly there are other sections of the economy that are continuing to hold up very, very well. And when you talk about the fiscal policy, again, the inflationary pressures that will potentially come down to structural factors, I think that will be a story that has been pushed aside a little bit, with the focus being on that cyclical retreat in inflation right now, and that is making the job of central bankers really tough at this point. Certainly not a job I would like to take. So yeah, I think that's why we continue to talk about being data dependent, and even with the Fed, we've seen the dot plot has been moving with every new data point that comes into place. I think central bankers, the models that they're using have certainly been found faulty, and they continue to lack visibility at this point.
Charu, just very briefly, inflation data out of the States Friday. You get a weak number there. Give us the market reaction.
I think a weak number is something that the markets are really positioned for. The real fun is when we get an upside surprise, if at all we do get one. And that's, again, a positive for the US dollar in that case.
Charu, nice to catch up. Perfect setup for the week ahead. Thank you very much indeed. Charu Chanana, Head of FX Strategy, joining us from Saxo Markets. Talking of the UK, apparently now safe haven seems to be the theme that seems to be emerging, certainly over our recent conversations. We've got a live televised debate, 12:30 p.m. UK time. Anna is going to be moderating that. Anna Edwards in the hot seat. The Conservatives' Kimi Badenock, Labour's Jonathan Reynolds, the business secretaries, will be joining her. Viewers in the UK can watch it live. Bloomberg TV is where you'll find it. You can catch it globally, though, on the terminal, on the website, on our YouTube channel. Bloomberg Radio will also be taking it as well. Before that conversation, we've got Philip Hammond, the former UK Chancellor, joining the Pulse. That interview, 9 a.m. here in London. What have we got coming up on this show next? We're going to walk you through your stocks to watch as we head into the open. The Prudential, the UK insurer, firmly in focus, launching a $2 billion share buyback program. Details of that and all the other stocks you need to be watching next. This is Bloomberg.
Think of AI as potentially being a great leveler, leveling the playing field.
It has this recursive aspect where it's able to improve itself.
Democratizing the expertise by giving people a hand up or a leg up in terms of starting.
Any effort to stop this or to just slow it down for the sake of slowing it down without also thinking about its positive development would be to cede the field to the irresponsible.
There's optimism surrounding AI today, and it is to some modest degree pervading the market. But I think that AI will not have a profound impact on non-AI companies for a good period of time.
A roundup of the thoughts on the future of AI from the San Francisco Fed CEO Mary Daly, former Treasury Secretary Larry Summers, and the co-chairman of Oaktree Capital Management, Howard Marks, of course. I thought it was interesting because we talk a lot about AI from the equity perspective, Guy. They're talking about it from an eco perspective. This was something that Larry Fink over at BlackRock initially said, this is going to help productivity. This is a positive at a point of a very tight labor market. That was, of course, I think 2 years ago or something. But now you're seeing everyone, even folks at the Fed, talking about the power of AI and how it actually helps on an economic standpoint.
The equity markets can't figure out how to price this. You think the economists are going to do a better job?
I don't know.
Nobody seems to be able to figure out. Nobody seems to be able to figure out what impact this stuff is going to have. We can barely price Nvidia and figure out what Nvidia is worth on a day-to-day basis. And that's the kind of just the arithmetic of picks and shovels and how many chips you can build. The wider macro effect, clearly it's going to have an effect.
But the fact
what
that
that
they're
is,
even talking about it.
Yeah, of course you've got to talk about it.
But they're just now talking about it. I haven't heard the Fed talk about it. Have you heard Jay Powell talk about AI yet?
No, Jay Powell's got enough to talk about right now without worrying about
but
AI.
When he does,
but he talks about productivity. He does talk about productivity, and he talks about what is happening here. And I think the AI story is just part of a bigger productivity story that's evolving in the States that I don't think we've got our arms around yet. Europe is not investing. We worry about the US deficit. But if you actually think about what's happening on the productivity side, the US is investing on the supply side. That's where the money's going. It's going to build a sort of bigger, better, more efficient economy that can run at a faster speed without creating inflation.
Well, the productivity story is interesting because on the same time we're talking about AI, we're also talking about the immigration debate. And I'm kicking this down to Thursday when we have the debate between Trump and Biden. The border control, border policy is going to be a big part of that. But the immigration story also affects the labor market in the next 12 months. It's a very fast turnaround. I don't know how you price that in either. No,
this takes us to our next conversation, which is, what do we do this week?
Yeah.
Are you data dependent? You've got PCE coming up on Friday. We're going to get EFO coming up very, very shortly. Or are you politically dependent? Are you looking at the French election? You're looking at the US debate. You're looking at what's happening here in the UK. You've got the EU leaders gathering. So this is a question that I'm going to put to Mark Cudmore, who's back from a little European tour. So he joins us now on set. Nice to see you this morning. What are you? Are you data dependent still? Or does politics dominate this week? Are we data dependent or politics dependent?
I think not data dependent. I think it'll be hard for the data to change the background picture.
Yep.
Politics clearly matters at the moment, but I think the European politics has been a bigger theme than the US presidential debate. So I'm more excited about the European political theme, but again, I think that's a theme that's unlikely to change this week. So I think in the short term, it's just that this market seems to be very, very consensus in its views. As you just pointed out, I've been away for a couple of weeks. I come back, and it's amazing. You're reading these notes. Well, nothing's changed, but the views are very consensus. Like almost everyone I read is like, whether they're bullish or bearish stocks, they're like, it's too much short term. They need to pull back short term. It's just like assumed that into month end there's going to be some stock selling. And that would make sense with some portfolio rebalancing, fine. But I'm just a bit worried about how consensus that is. And flip side is everyone is completely consensus that nothing can stop the dollar right now unless, Japanese intervention comes in and helps change the narrative there. But otherwise, it's clearly dollar bullish.
And is Japanese intervention going to come in?
I don't think so. At least, I think this 160 hype is completely ridiculous. I think, that it might keep on going higher before they come in again. But ultimately, intervention is just an excuse for macro traders to resell the yen at much better levels. And I think that's the key narrative there.
So what do you do with this consensus market? Do you just keep the momentum, stick with it?
I think yes, actually, sadly. Fine, if stocks are due a short-term pullback, but nothing more than short-term pullback. Our colleague Simon White last week did this excellent column about excess liquidity, and I think he's absolutely spot on. I think that if there's a short-term pullback, you still probably buy that dip. I think that the macro backdrop still remains incredibly supportive. It's the same narrative all year that we have central banks that are trying to be more dovish than the economics would justify, and the economic growth is still strong. So, fine, I'm back from holiday, maybe things are technically overbought, maybe we're due a bit of correction, but ultimately, a month from here, I expect stocks to be stronger around the world. Stocks stay bullish.
Stocks or Nvidia?
Good question. I think stocks overall, I think the rally can broaden out, but I've argued that for a while and clearly been wrong. Nvidia, I just think, is a completely different beast. You know, you mentioned this a few minutes ago. Like, people have no idea how to value Nvidia because its kind of growth is just going up so quickly. But I think that it is not just Nvidia. I mean, everyone thinks the Nvidia is a bubble that's going to pop at some point, but I don't see the reason for it to pop now. You got to wait to the next earnings season. It's got to have an earnings season at some point that's going to disappoint. In the short term, though, I think that Nvidia continues to drive broader markets higher, including markets outside the US.
All right, Mark, don't go anywhere. We've got a caught my eye, which I admittedly say guys stepped all over. But there's a chart that I want to bring to our global audience here when it comes to the Japanese yen. We're going to bring it right back to that part of the world because we're watching a lot of what's going on with the euro, what's going on with the pound, of course, what's going on with the dollar. You mentioned the yen. But to your point, traders aren't really pricing in the risk of any intervention. This is kind of showing this via risk reversals on your screen. Despite even overnight, we heard some commentary coming out of Japan saying, look, we'll intervene if necessary. Why do we not act more when it's still such a big part of the hedging scheme for a lot of folks?
Because interventions never really work over the long term, particularly when trying to defend your own currency. Of course, weakening your currency, you should be able to work just by printing more cash. But defending your currency is hard, and the fundamentals against the yen just remain incredibly strong. This is a country with deeply negative real yields and not a particularly strong economy. It's not like their massively easy policy is generating a big inflationary wave. At some point, this is going to change, but I just think it's one of those stories that, you know, we've gone from whatever 105 to 160 over the last few years. Before the narrative changes, we could be at 180, 190. I just don't see why you try to preempt the change. We need the fundamentals to change before the intervention matters, and I think the policymakers know that. They're just trying to slow it down.
And I think in the last week as well, we heard the U.S. putting Japan on kind of a watch list as well when it comes to currency intervention. They didn't go as far as calling them a currency manipulator the way that they have with China as well, but it still caused some concern because traditionally when you have this kind of intervention, at least to this extent and for this long, it needs to be coordinated with some of the other G10. At what point does the Treasury need to worry about that even more?
I think that these reports we get very excited about over time, and then we kind of trade them for a few days, and then everyone forgets about them a couple of weeks later. So I think that won't be the kind of big news. I do think you might, if dollar yen keeps on going higher, and we are like another 10% higher in a few months, at some point we're going to talk about whether another Plaza Accord type deal and whether there's kind of coordination to get to stop dollar strength. But I don't think we're close to that yet. It's bothering some Asian countries, but most of the rest of the world's not too bothered, and we know from the US politics they don't really care about.
But what would that take? Like, what is that red line?
I don't think it happens because I think that something else derails it since then. Like, it might be the US presidential election, it might be Fed policy. I think something else derails since then. What takes it to happen? I think much more extreme levels. I think basically people like giving up. You start seeing a bit of a currency crisis. It's maybe where you see suddenly dollar yen going higher, massively higher in a week despite intervention out of Japan, and everyone goes, oh my God, this has got out of hand. We've got a bit of a currency crisis. I don't think we're close to that yet.
Biggest volatility event of the week?
Good question.
You can only pick one.
Yeah.
Well, PC.
Do you think it's PCE?
Well, I was going to say, I'm assuming, you think the US presidential election, do you, sir?
I do, frankly, yeah. But I'm biased.
I think short-term people get excited about that, but I think if they ignore it by a week later...
So PCE, we get a slightly softer number, we get a slightly stronger number. The biggest potential for things to surprise, presumably, has got to come out of the politics.
Fair. Okay, that's probably fair. I actually will accept that. So if we're going to get a sudden, trigger event, it will be on the US political side. I actually think that's fair, because I don't think PC changes the narrative. It's more that I also don't think the debate will change the narrative. But you're right, if there is going to be a surprise, it's going to come from that.
Mark won't be staying up all night and watching the US political debate. He'll be back with us the next morning to analyse what exactly it means for markets. Markets Live Executive Editor Mark Cummell, thank you very much indeed. You can get Mark and the rest of the team's thoughts. Mark's and the rest of the team's thoughts. MLIV Go, of course, is the fantastic function on your Bloomberg terminal. Let's figure out what we need to watch on the single stock story. Joe Easton has got all the details there.
Morning, guys. So we're watching Prudential today. This is the UK-listed Asia-focused insurer, which announced a $2 billion buyback overnight. Now, it is benefiting from a rebound in the Hong Kong economy post-COVID. Now, Citi analysts saying that this buyback is twice as much as they expected to see, and it is coming earlier than expected as well. They didn't expect to see it until August. Now, sentiment has been pretty weak in this stock over 3 years. It's actually down 50%, with risks including the Chinese property market weighing on the insurance industry over in Asia. But this could be positive news for that stock today. Then we're also back in the drink space. This time we're looking at C&C, the owner of Magners Cider. Bloomberg reporting exclusively that an activist investor called Engine Capital has taken a 5% stake in the company, according to Bloomberg sources. Now, Engine says that this company is undervalued and they want it to review the business and potentially even look to do a sale. They think it's attractive to both industry players and private equity as well. Now, this stock trades around 60% below its pre-pandemic price. They had to do a big fundraising back in 2021, diluting the shareholders, and it hasn't recovered even after the pubs reopened, of course. And as we can see on the screen there, lots of positive analysts on this one, 14 buys. One of them is Jefferies, which says that this is the best case scenario that they had expected for this stock coming up in terms of the valuation. Then we're also looking at Argenx. Now, this is a 30 billion euro drug maker listed over in Belgium. The company getting US approval for a rare nerve disorder drug. Now, it treats a condition that leads to muscle weakness in the arms and legs, according to the statement. And potentially, this is a $3 billion market because there are around 36,000 people across the world that suffer from this illness. This drug approval could boost that stock today.
All right, Joe Easton, our equities reporter there with some of the stocks to watch. Is something we're going to be keeping an eye on. In addition, by the way, to some headlines coming out of Britvic as well. It looks like Carlsberg has now reached a pact with PepsiCo as well. We're going to bring you the details after the break and ahead of the European market open. Futures still a little bit mixed. A lot of that pricing in some of the geopolitical tensions, the turmoil, and of course the sell-off that we saw last week as well. Stick with us. More ahead. This is Bloomberg. Welcome back to Markets Today. We're just a few minutes to go until the start of cash equity trading in the UK and across Europe as well. You're seeing futures a little bit mixed. No main optimism, a little bit of caution given this week is full of not only political turmoil, plenty of data as well, plenty of ECB speak. Guy, take your pick. Where do you want to start?
So we sold off on the Friday session.
Yeah.
We came lower kind of a couple of hours into trade and kind of bounced along the bottom of the trading of the range during the session Friday. Witching wasn't a big issue. It turned out to not be that big an event that we thought it was potentially going to be. So we come in this morning. A little bit of weakness, I think, on the agenda. Seeing a little bit of a bid early on come back into the bond market, which I think is interesting given some of the things that you've been talking about as well. Only a single sector was in positive territory Friday. Does that reverse a little bit coming into the beginning of this week? Doesn't feel like it's a single stock story. Feels like it's a macro story this week. Take your pick. You're either data dependent or politically dependent.
I'm going to say politically dependent this week, only because you've convinced me in the last hour. I think it's important, though, because we're talking a lot about it in the concept of trade. I think trade is the overlying theme. Whether the China read-through into the EU happens, whether you are seeing kind of the dynamics between the EU get the further apart, whether it's France, whether it's Italy, whether it's what's going on in Brussels specifically, but then also the debate and what the tariff story actually looks like when it comes to being tough on China.
Well, let's come back to the tariff story for just a moment. Does the car sector react this morning to the fact that we have trade talks between the EU and China? Is that something that is a positive or a negative? I think maybe for the Germans it could be a positive. For the French and everybody else, maybe it's more of a negative because you could see potentially Chinese cars, EVs coming in here. The Chinese are going to build here anyway. So maybe this is a moot point. But nevertheless, it'd be interesting to see how that sector responds to the story. But I think the technology story around the debate could be quite interesting as well. So
it is.
Names like ASML in focus this week.
Especially because that's just kind of held in between the sanctions story. We have to see how tough they go. It feels like Biden wants to be tough on China. Trump wants to be tough on China. What does that show up in the markets? Let's look at it right now. When you look at the market open, it looks like the FTSE 100 starting off on the back foot here. A little bit down, seeing a little bit of red. AstraZeneca, Shell, these are your biggest index weights right from the get-go.
So oil's been softening up. So we've seen this big rise in oil recently. That's beginning to roll over just a little bit, despite the fact we have really strong aviation demand. And actually the driving story out of the States is interesting. But does that higher oil price that we've seen recently show up in the PCE data Friday? I think will be interesting. You're right. AstraZeneca, BP, Shell, all a little softer this morning. Anheuser-Busch seems to be gaining. Siemens up. Some of the banks are also bouncing back. ASML on the front foot as well. Interesting to see Nvidia selling off Friday as well. Is there a read across into the technology sector here in Europe too? At the moment, the bulk of sectors are in negative territory. Banks are rising, so that's certainly one area that we are seeing some gains. But there you go. The auto sector, the biggest lead gaining sector story this morning here in Europe. It is up by 0.5%. Craig Trudell will be joining us very shortly to talk about that tariff story.
Yeah, it's a really important one. And I should mention, this is one we haven't really talked about as well. UBS is one of your biggest upside contributors as well from an index perspective. On Friday, it looks like FINMA had talked a little bit about how much they're going to be regulating UBS and post-Credit Suisse, of course, but in terms of those capital buffers. This is an ongoing story as well in terms of how the EU, and specifically how the left in France actually approaches some of these banks as well, do start to increase those capital buffers in Europe, specifically when Jamie Dimon has been really pushing back against that story over in the States as Europe has some catching up to do. That's something that the market has to pay attention to when it comes to the bank sector.
I want to go to a story that's just come onto my screen, and that is this polar polls that I thought it would be coming about half an hour ago. You've got to sort of do all the maths on this and figure out exactly kind of where we are. But this is the polar polls that Bloomberg pulls together. Marine Le Pen's far-right National Party, further gains in the first round. The first round, big critical, obviously, in that election that we've got coming up Sunday. So it looks like Macron increasingly looks like he is going to have to share power. It does look as if the right and the left are likely to be in that second round rather than Macron's party. So it's going to be, again, French politics front and centre, but this does seem to confirm that Le Pen is making further gains.
Yeah, Allianz doing a great analysis over the weekend. I read in The Economist, I believe, that basically, if there isn't some sort of Macron leadership, either way, you're going into some really scary deficit territory from France. Does that then invite, perhaps, yet another sovereign downgrade down the road?
Maybe from others, potentially.
Yeah.
I think that definitely is the risk this morning. French bonds, though, are a little bid this morning. Yields are just coming a little bit lower. Where does that mean we are in terms of the spread over Germany? We're trading at 78 bips over Germany this morning. Let's pick up. It's the perfect point to pick up with our next guest. David Zahn joins us now. He is the head of European Fixed Income at Franklin Templeton. Good morning.
Good morning.
France is trading 80 over Germany. How high could that number go?
Well, we're short France at the moment versus Germany, so we think it could easily go to 100 over.
Easily 100?
Yeah, and I think that's where we'd start looking to cover our short position. If we got wider than that, then I think that's when you start thinking about
What would get
buying.
us wider than that?
Well, I think that we have the left and the right both doing really well in the polls, as you pointed out.
Yep.
Left is has huge spending plans. The right has big spending plans, and we also have a deficit reduction plan from the EU saying, France, you need to get your budget deficit down, which has been a problem for a while. So I think all of this just means that French bonds should be trading wider. They should probably be trading more flat to Spain, and they're really looking at how they trade versus Germany.
Go ahead.
Okay.
That's the follow.
Sorry, I usually ask two and then you ask one.
No, go for it.
Let's talk, therefore, about what the wider implications are. You talk about the relationship with Bonos. You talk about the relationship with Germany. Let's bring in BTPs to the conversation as well. What's the ripple effect off the OAT market into the rest of the continent?
Well, we have to remember the OAT market is one of the biggest markets in Europe, and so it does have, it's very liquid. So as it pushes wider, it will impact other peripheral markets. We also have Italy is going to go into a deficit reduction plan, and you're going to have this discussion with the EU over the next 3 to 6 months of how they're going to do that. So I think Italian bonds, we're underweight Italian bonds as well because we think there will be under pressure as we have this disagreement or exchange with the EU as they determine how to reduce that deficit.
Can I ask you a market plumbing question here? Especially when we're talking about the risk of some of these increased capital buffers, this kind of holding on to some of the sovereign debt that, of course, is affecting the French banks. How does that show up in terms of the turmoil? Is there any sort of risk of some sort of liquidity crunch as people navigate this?
I don't think not in French OATs. No, I don't think there's going to be a liquidity risk. I mean, they're very liquid. They move quite easily. But I do think people will start to question, you have this big liquidity buffer sitting in OATs. Is that the right one to have it in, or should it be in something else? I don't know. But I think in general, banks always hold their domestic debt, and that makes sense because that's what the regulator wants.
What about in relation to what's going on in the States? Of course, that debate coming in on Thursday. Is that a tradable event for you?
I think the debate will be interesting to see how they both perform, what topics come out, but I don't see that really affecting the bond markets directly.
But relative to Europe, for example, we talk a lot about the debate in the context of China and what that tariff story looks like. We still have steel tariffs on Europe. There's still, I say we as in we America, tariffs on Europe. There's still a question of what kind of the IRA looks like or potentially looks like in the next 12 months. Is any of that something you can price in?
Well, I think all of those are longer-term issues, but I don't think they'll affect what the price of the Treasury is today. I think it's really, we know that we're going to have either Biden or Trump is going to be the president, and we know how they'll both act because we've seen them both, take office before. So I think that you can start to price it in once you have a clearer view of who's going to be in charge. But both will want to spend more money, and so it's not like the budget deficit in the U.S. is coming down, which will keep yields, I think, under pressure.
Let's come back to Europe.
Yeah.
You get Meloni's in power. You get Le Pen assuming more power. Some sort of a joint approach maybe is taken. It's not there at the moment, but maybe it comes. Does that take further European integration in the bond market off the table? Does it take joint spending off the table? Does it make harder for Europe to fund at a supranational level? Kind of what are the implications for the EU of some of these elections?
Well, I think overall in Europe we've seen the right doing much better, and we saw that in European polls, but also in individual countries. And I think if you have two of the three largest countries are both in a far-right government, I do think it will impact how the EU behaves and how it moves forward, and it probably doesn't mean as much integration in the short term. I mean, obviously these things can go back and forth over the next 5 to 10 years, but I do think that Meloni is very strong, given how well she did in the polls during the European election, and she will use that power to actually try to push things around. If you have Le Pen also coming in, I think you have two very strong leaders who will try to navigate the EU situation and probably make it different to what it is now.
Is the gilt market a safe haven right now?
Yeah.
Can't believe those words just came out of my mouth.
From EM.
Well, actually, it's really interesting you say that because we actually are overweight gilts versus Europe because we believe that actually gilts are a bit safer place to be than in Europe at the moment.
Relatively or just in general?
In general. We think that actually the Bank of England should be cutting rates. I'm not sure why they didn't, if it was elections coming up that they decided not to. But we think that the economy here is weaker and therefore we should have rate cuts coming through and gilts should perform.
Walk us through the logic of that. When the narrative seems to be in France, in the UK, arguably in the States as well, that if deficits are the concern and there's no real room to spend anywhere, what do? How do you price that?
Well, I think you have to look at which leaders are actually trying to contain spending. And I think in the UK, they've done an okay job at trying to rein in spending. And I think that's one of the things I'm not as concerned with Labour getting in is there isn't any money to spend. They don't have a lot of flexibility. So probably have to, and given what happened in previous administrations, they're probably going to have to keep it quite tight to make sure that we don't create any volatility in the gilt market. I think France, they may be a little bit more loose with the spending, depending on who gets into power. But I do think that a lot of people look to see what Meloni has done in Italy. And she's done an excellent job of this is what her policies were when she was on the campaign trail. And then she really got it much more normalized for when she got into power to actually help the Italian government deal with the bond market.
I'm going to steal Guy's question really fast. Is that a function of fiscal spend, though, for Meloni?
It's a function of fiscal spend, yeah.
And can that be replicated elsewhere?
I think it can, but remember, Italy's been spending lots of money. So it's just, I think, more how they've been communicating with the bond market. Their deficit is will be above 5% this year, and they will be in this deficit reduction plan. So I do think it's more how the communication has happened.
We're starting to see credit going a little wider. What are the implications for the govies of that? Like, what is it? If this carries on, a couple of deals pulled last week. If that carries on and we start seeing credit going wider and wider, even at the IG sort of level, what does that mean for is there more space on the govie side?
Well, I would probably flip that question around and say that actually by govies going wider, it actually pushes credit wider because all of a sudden you can move into governments that have spread over Germany and pick up yield versus what you'd have in credit.
So it didn't start. You don't think that move started in credit?
No, I think it started in the govies, and then it will flow through into credit, which is one of the reasons we've been reducing credit quite a bit over the last year.
When you're reducing credit, though, how much of that is simply a function of people kind of sitting on the short end of the curve? When does that dynamic go away?
I think the short end will go away once the ECB continues their rate cuts, which we anticipate they'll cut once a quarter for the next 18 months. So we're headed to 2% in Europe. And if that happens, then I think short credit isn't nearly as attractive. Right now you can get between 3.5% and 4%. So why not just buy short credit, 18-month paper, and sit on it for the next 12 to 18 months? That actually seems quite reasonable. But once those yields come down, then I think people will start to push out the curve and look to see where are other opportunities.
Did the steepness finally happen?
Yes, the short end will outperform.
Yeah, they finally take off at that point.
Yeah, because the long end will be more anchored by what's going on in the U.S., whereas the short end will be more anchored by what's going on in the ECB.
Is 5% on the 2-year enough? Is that enough yield in a dynamic where you're seeing the stock market and EM currencies and everywhere yield double digits, private capital yielding double digits? Is 5% in the Treasury market enough?
I think it's enough for where we are now. I mean, we expect the Fed to still be looking at cutting next year or end of this year. And so I think in that environment, short rates at 5 seems quite reasonable. Now, longer term, if we go more medium term, like 5 to 10 years out, if we keep spending with 7-8% budget deficits, then you can probably start to question whether 5 is enough. But at the current juncture over the next couple of years, yes, it definitely is.
For now. We'll take it for now.
For now, absolutely.
David, nice to see you. Thanks for talking about us. David Zahn, Head of European Fixed Income, joining us from Franklin Templeton. Quick look at some of the big moves around Europe to see what they're doing. This is what the Core 6 looks like first thing this Monday morning. A reasonable amount of green on the screen, but as you can see, it's not a great deal. It's interesting to see Nestle maybe rising a little bit more than most, but it's Ferrari that is up and doing very nicely. The car sector front and centre this morning as we see the possibility of tariff talks between China and the European Union on those car tariffs. We'll come back to that story in just a moment. Let's turn our attention, before we do that, to the other individual stocks we need to be watching. Joe Easton, back to you.
So we're starting with Prudential, Guy, and we are seeing a bit of a boost following that $2 billion share buyback that the company announced overnight. That was earlier than expected by analysts, and we're seeing an almost 5% gain in that company there. It was only expected to be around $1 billion, so that is much better than expected. We're also looking at the drink space, a couple of things going on that we mentioned in stocks to watch. Firstly, that activist stake in C&C Group, seeing a 1.4% gain on that one at the moment. But the big one is Britvic, that breaking news that PepsiCo potentially giving its approval on the bid that came in from Carlsberg. Now, Britvic actually has an agreement to bottle and sell a lot of PepsiCo products in the UK, like 7-Up, for example. So PepsiCo is kind of the kingmaker in this deal. They need to sign off from it, and they have said in a statement that if the deal goes through, they will be willing to back away from that and allow Carlsberg and Britvic to do their own thing. So as we can see on the screen there, an 8.5% gain for that stock, a really big move. And Carlsberg coming down, that stock was absolutely slammed on Friday following that deal news. Then we've got Argenx. We'll take a look following that drug approval in the US. It's a rare nerve disorder treatment, and it has got the US FDA backing. And there we go, a 7% gain for that stock today. Potentially a $3 billion market that's addressable for that company with around 36,000 patients. So it is a big drug, and that one is gaining over in Belgium today. We'll look at some earnings stocks as well. There's a few to bring up. There's Prosus, actually reporting its first ever e-commerce profit. Now, this is the company that's listed in Amsterdam and also has a relationship with Naspers. They own a stake in Delivery Hero, a bunch of other websites, but potentially the valuation looking a bit heavy on that one, and actually it's coming down very slightly there. A big dropper on the screen we've got, I'm seeing that one, SIG, down 15%, almost 14.6%. This is a UK construction supplier. They make insulation and stuff that goes into ceilings and roofs, that kind of thing. Getting absolutely slammed on a profit warning today, down almost 17% now, the worst performer in London. And you got THG down the bottom there. They've announced a pact with Frasers Group, a company that is, of course, owned by Mike Ashley and controls Sports Direct. This is around selling their luxury products via THG's platform Ingenuity, and that is seen as a positive, up 5% following THG's partnership with the retailer Frasers today. We'll look at the auto stocks because there are talks going on between the EU and China around tariffs. The EU and China potentially trying to see if there's any leeway on whether they can remove or at least not impose as strict tariffs as hoped on the car makers. We've seen some gains there. Volkswagen, Mercedes, BMW in Germany all gaining, not so much movement in Renault, but the German car makers definitely getting a boost ahead of those talks today. Speaking of German companies, one stock absolutely slammed today on a ratings downgrade is Zalando. Now, this is the online clothing retailer and also sells other goods as well. And Morgan Stanley, a long-term buyer of that stock, downgrades it today. The stock was down as much as 10% at the open in Frankfurt. They no longer recommend you buy that stock, coming down to equal weight from overweight. And then my final morning call is Hochtief. This is in construction. Jefferies likes this one, upgrading it to buy. They say that the company is feeding into building data centers. So it's an AI play, a construction company that's potentially exposed to AI through the building of data centers. So Hochtief upgraded at Jefferies, and that one, big earnings upside and big price target upside, 124. I've just seen that, so potentially another 25% upside. That one's up 7% as Jefferies upgrades Hochtief.
All right, there, Joe Easton from our equities team. We thank you so much for walking us through some of the stocks that are moving in the early session. Coming up on the program, China and the EU agree to hold talks on the bloc's plan to impose hefty tariffs on EV imports. We're going to dive into the details next. Stick with us. This is Bloomberg.
Our duty is to be able to provide our client the motorization they want. If they want ICE, if they want hybrid, if they want electric, we have to be ready for that. So for us, for me, I think it's fair to tell you which is the split of the model we will offer to our client. For forecasting what is the sales is difficult. If you want my point of view, it's clear that the three kind of colors, the three kind of car will stay together for a while.
Benedetto Vigna, the CEO of Ferrari, speaking to Bloomberg Friday as the company comes up with its details of what the new EV, the Ferrari EV, is going to look like and sound like and go like quite fast, I think is the answer to the latter question. That's where the magic all happens in that factory. Cars definitely front and centre in terms of the European markets this morning. China and the European Union, they've agreed to discuss the bloc's plans, the European Union's plans to impose additional tariffs on EV imports, which could take levies to a level as high as 48%. That was agreed by Valdis Dombrovskis Friday. That was when that call happened. That's what that came out of. This at the same time as we see Germany's Vice Chancellor Robert Habeck wrapping up his trip to Beijing. Let's pull this all together and try and get an angle on what is going on here. Bloomberg's global automotive editor Craig Trudell joins us from Oslo. Bloomberg's executive editor for China, John Liu, joins us out of Beijing. Craig, let me start with you. Why is the EU suddenly deciding that it probably needs to talk to China about this rather than simply imposing these tariffs?
I think there's a real concern here about blowback, and there was this was a deliberate process, and from the perspective of Brussels and the German Vice Chancellor, Germany in general, they view this as different and distinctive from what say the U.S. has done, which was kind of in short order put in place tariffs. The EU went through this 9-month-long process of investigating the extent of subsidization and sort of came up with subsidies and duty levels that it felt were sort of commensurate with the amount of support. There isn't necessarily a willingness, at least communicated thus far on the part of Beijing, to see that as different. There was really a sort of lashing out and highly negative response to this. There's already been talks of putting tariffs on big engine cars that would hit German manufacturers. We mentioned Ferrari off the top. So there's real potential here for blowback, and the EU would like to avoid that and sort of parse the differences between what they're doing and what, say, the U.S. is doing.
John, weigh in here from the perspective out of China, specifically when we're talking about these talks actually becoming underway. What concessions might be on the table from Beijing's end?
Concessions, I think it's hard to say right now. I think right now Beijing is out with the stick. I think whatever the carrot might be, we'll find out later. Beijing's learned from a trade war. We had the trade war with the Trump administration a few years back. And I think the lesson Beijing has taken from that experience is you got to talk tough. You got to be out in center with what you're going to do to retaliate if you want to end the day with a good negotiations.
Well, Craig, way back in on the negotiation that John is just talking about, because we know these negotiations are ongoing between, say, the likes of China and the States. How might Europe take a little bit of a different approach? And I'm going to put this in the context of some pretty harsh commentary coming from the likes of Mario Draghi, just one of many who are saying enough is enough.
Yeah, I think, one of the sort of things that's been, mentioned is maybe that the EU would like to have, localization of China's car makers, draw some investment and, have that, sort of support this idea of, building up of jobs and paying of jobs that at wages that companies in Europe are accustomed to having to pay. That's all well and good, but it sort of ignores the fact that, this is an industry that is so vast now in China where, manufacturers have so much overcapacity, both at the, end level of cars, but also, the batteries for electric vehicles is really important. That has driven down costs to such a dramatic degree that the rest of the world just, it's a real concern as to whether or not they're going to be able to compete. And so, until and unless that overcapacity is addressed, there's really a concern about the sort of long-term outlook for European manufacturers.
And John, let's cover that from the Chinese point of view. There is this desire by Europe to see manufacturing moving to Europe, and that is certainly something from a job point of view. You can understand why they would want to do that. How will the Chinese react to this? Are the Chinese authorities comfortable with the idea that we are going to see capacity moving out of China into Europe? We do, as Craig says, have huge amount of capacity in China currently. What do you think the authorities in Beijing, how do they want to see this story develop? Are they comfortable? Would they like to see Chinese automakers going global, or do they want to keep them at home?
So the fact that BYD is already committed to building quite a large facility in Hungary, the fact that we have battery maker CATL building a facility in Germany, I think it's inevitable that Chinese car makers are going to go abroad and build plants around the world, and that I think Beijing is okay with. I think the main concern at this point for Beijing is it cannot appear to a domestic audience to be allowing the Europeans to put in tariffs without doing something in response to show that it's standing up for Chinese interests. And so as long as that's in place, unless the Europeans, there's some negotiation about maybe taking those tariff levels down a bit, something that Beijing can walk away with and sell to a domestic audience as showing that it's done something to protect Chinese companies. Without that happening, I think Beijing's going to be under a lot of pressure to show it's tough.
John, is there another market, though, that Beijing could then target if you kind of see this worst case scenario where you do see that trade limited to the U.S., limited to Europe, and in whatever method that looks? Where else are they targeting to make up the gap in terms of market share? Very quickly.
I mean, the biggest market right now is Southeast Asia. I think that's where you've seen a lot of expansion of Chinese marketing, sales, production. There are factories going up in Southeast Asia as well. So I think that's where China would look if Europe got cut off.
All right, Bloomberg Global Automotive Editor Craig Trudell in Oslo, and Bloomberg's Executive Editor in China, John Liu, joining us from Beijing. We thank you both so much for joining and bringing us that crucial context. We're going to be back with plenty of what the political turmoil looks like, how you price it in terms of the market. That conversation and more coming up next. This is Bloomberg.
There are some very good global players in Europe, strong secular growth players, and we would want to take advantage of that. Some of the corrections are overdone in our view.
It's a great day to invest in Europe.
When it comes to the government bond market, we have a preference for European government bonds and UK government bonds over US treasuries.
Positioning is very light. Nobody wants to be invested in Europe. Everybody's underweight Europe.
Can't help myself but be optimistic because against all that, you got a valuation 10 points below the S&P.
Sentiment is awful. Look at the elections, the growth prospect.
What I would look for actually is for the euro to stabilize first, and then maybe the equity market will follow.
When you look at projections for economic growth, the consensus is expecting Europe to rebound and start growing again in 2025, 2026, as opposed to what you're seeing in the US where we have a slowdown.
some of the guests that we've had on our show in the last week, really talking about the strength of the European stock market relative to the United States. We're talking about valuations, et cetera. Let's add one more voice to the chorus, or potentially one more voice to the chorus. Wolf von Rotberg, equity strategist at Swiss private bank J. Safra Saracen, joins us this morning. Wolf, we just heard from some guests talking about just how bullish they are on Europe, despite the backdrop that we're seeing of a lot of political volatility. Where do you stand on that? Are you bullish Europe?
No, not anymore. We've removed our European preference like around the beginning of June, more or less. We had moved Europe to, or the euro area in particular, to our most preferred market at the beginning of the year, because we saw that the cycle is troughing, and obviously you would want to enter cyclical markets such as the euro area at a time when the cycle is just bottoming, and that's what we saw on the PMIs in particular. And if we look at the most recent data, I think we got a confirmation that we were right in terms of our positioning at the beginning of June. The PMI data, which we received last week out of the euro area, was quite soft. And I don't think that this had to do much with the French election or the European parliamentary election, rather than just being a function of, kind of the credit cycle rolling over once again, and less, let's say, demand coming from outside Europe.
So what do you need to see to get more bullish here? How far do valuations have to drop for you to say that's a cheap buy?
It's not as much about valuations in our view. It's more about the cycle in general, as mentioned, which is rolling over. And then in particular on the rate side, I think, we've seen the banks performing quite well since the beginning of the year, which continue to be driven by an expansion of their net interest income over the past, let's say, 16 to 18 months. And this seems to be rolling over as well. And we know the banks are a very important driver of the European performance. And we are just getting a bit more cautious on the banking sector in Europe. And again, regardless of what's happening in France and what's happening to bond spreads versus the Bund, it's more that the general interest yield, or the general yield backdrop is changing, saying the long end of the curve is coming off a little bit, and the short end of the curve, which matters for banks, which is basically deposit rates, which have been more or less nailed to the ground, are starting to rise. So banks are just seeing the peak of a very strong cycle they've gone through over the past 2 years, which just makes us more cautious here. So there's nothing right now which would let us become more optimistic from a let's say 6 to 12 month point of view on Europe.
Wolf, good morning. It's Guy. How do I hedge my Nvidia concentration risk if I'm not buying Europe?
For us, we are a bit more defensively positioned, saying, we've seen the very typical, kind of bond proxies, defensive sectors, healthcare, staples, utilities, or utilities maybe is a bit of a special one, but healthcare and staples underperform. We think that it has to do a lot with what's happened in the rate space, saying, if yields come down, these guys should have some room to move higher. But we also like the utilities, and in utilities, obviously, we get a bit of a structural story here as well, with electricity consumption going up. More of a longer term story has to do with AI to some extent, but I think it's still an interesting investor to be positioned in. In addition to that, and that's a bit of a trickier one, obviously, but I would still think that small caps have room to rise if we were to see the cycle, let's say not moving down sharply, but rates though coming off more aggressively. So rather stable cycle, rates coming off would be favorable for small caps, but in general, defensives.
Okay, let me ask the same question from a slightly different point of view. If I'm not putting money to work in Europe, if I'm not overweight Europe, what does that tell me about what I want to be doing in the United States? If I'm thinking about my portfolio, do I start with the States and then think about everything from there? Or do I if I'm a European investor, I start with Europe and think about whether or not I want to put money over on the other side of the Atlantic? The US market is outperforming. If I want to outperform as well, I have to be there. How do I square that circle with Europe involved? Or do I just not include Europe in that equation?
I think it makes a lot of sense to take exposure to the US. I think the US cycle has let's say a bit of a a bit more breadth. It has a bit more life in it than the European cycle for the time being. I wouldn't, go into the very concentrated AI space just because I think, let's say, 6 to 12 month view, we may see a bit of a, let's say, normalization at least of the capex spending on AI, which could basically hurt these valuations which we are currently seeing. But in general, I think the cycle in the US could hold up a bit better despite the high valuations which we are seeing at the index level. But if we dig a bit deeper into the sector level, valuations don't seem to be as exaggerated as they are at the index level. So saying, we are neutral on the US market as well. We have a preference for the Swiss market in particular, which has to do with our defensive preference. But if I had to put it down, saying US or Europe right now, I think the US looks more attractive again on the back of a, let's say, somewhat stronger cycle, not aggressively stronger, but somewhat stronger.
Wolf, does the currency picture factor into your thinking here? How are you viewing further weakness expected in the euro?
Yeah, I guess the euro will weaken somewhat on the back of what we're seeing in terms of political risks and in terms of the cycle. If the euro weakens in an environment in which the cycle is holding up for other reasons, then cyclic reasons, saying you have basically a sharper drop in inflation. Maybe the rest of the world is just doing somewhat better and is moving ahead. The euro is lagging. That's the best environment for European equities. But I think in the current environment where the euro is more a function, let's say, of the European cycle itself and of political risks potentially, I don't think it's as much of a support factor for European equities or for euro area equities in particular as it would be in an environment in which the rest of the world is just powering ahead in a more aggressive way. And here I'm talking in particular about Asia, where Europe, tends to be a big derivative of in terms of the cycle, and we don't see the support coming from Asia.
Is the UK a safe haven right now?
In terms of the equity market, there may be a bit more stability. Obviously, it is more of a defensive market than the euro area is. But what I think where we should be a bit more cautious in the UK is in terms of the materials sector, the energy sector, where we are not as positive as we were just a couple of months ago. We also downgraded our UK overweight to a neutral in line with Europe at the beginning of the month. Just because we thought, okay, look, we look at commodity prices, we look at copper prices, for example, we look at oil prices. There seems to be some weakness creeping in, again, a kind of derivative of the Asia manufacturing sector, to some extent of the US manufacturing sector, which has been weak on the ISM in the latest print. We get the next one on Monday. Let's see what it'll tell us. But definitely relative to the euro area, we would prefer the UK. That's for certain.
That's for certain. Wolf, great to catch up. Thank you very much indeed. Wolf von Rockberg, equity strategist at J. Safra Saracen, the Swiss private bank. Thank you very much indeed, sir. OK, what else have we got coming up for you? We're going to focus on the UK. We've got an election next week. Let's not forget about that. We've got a business debate. It's happening live here at Bloomberg, 12:30 p.m. UK time. Anna's going to be moderating, Anna Edwards moderating with the Conservatives' Kimi Badenock and Labour's Jonathan Reynolds. Very much looking forward to that. And we're going to talk about it next. This is Bloomberg.
This is Mark today. We're about 43 minutes into the European trading day. Seeing some green on the screen, even though we started on a back foot here. Eurostoxx 50 higher by about 0.4%. So perhaps a little bit of optimism, but investors still very much on edge, especially in France, over the prospect of a change when it comes to the balance of power. There's a lot to digest when we're talking about the political turmoil. Sectors specifically having various reactions. Banks, highway operators, utilities, of course, at the forefront of a $240 billion sell-off on the Paris exchange. The far-right national rally continuing to hold a sizable lead in opinion polls, with President Emmanuel Macron's bloc trailing in third. I'm joined now from Paris by Julian Pontus, Bloomberg's French equity markets reporter, bringing us the latest on everything we need to know. Julius, let's start big picture. Walk us through the polls.
Well, in a nutshell, the far right is leading by 5 or 6 points to the left wing, and Macron's centrist party is way behind at 20%. So at the moment, there's no clear path to victory for Macron. We're just a week from the first round, and it seems like the far right will win this election, but will they have an absolute majority? Will they have a smaller majority than expected? It's anyone's guess. But one thing is for sure, Macron's party is not seen, winning this election.
Julian, that's the problem, though, isn't it? Because this is uncertainty. We just don't know. It's anybody's guess. This isn't a quantifiable risk that we're dealing with here at the moment. Investors have sold French banks, they've sold utilities. That feels like a logical reaction in so many ways. But how are they bigger picture? You talk to a lot of them, you talk to a lot of traders. How are they dealing with this uncertainty? And how long do they think this uncertainty will last?
For a lot of brokers, when you read their advice, they're basically telling you to stay away. If you're not in the French market, there's no positive scenario for you. There's no upside. If you need to be invested, say you're a French manager and you're selling, a fund that is exposed to France, then you need to cherry pick your way out of the safest, find the safest stocks possible. Basically, that's stocks that are, have 90–80% of their sales outside of France. They have no political risk. So you need to find, safe bets among, say, industrials or pharmaceuticals, or find ways out of the French political risk. But if you don't need to be invested in France, why would you?
Julian, can you walk us through kind of the sector-by-sector take on this? I mean, we pay a lot of attention to, of course, the banks naturally. It feels like they got the biggest hit. What are the other places we should be watching for in the market?
Media, for instance, the far right wants to, said they were considering privatizing the French equivalent of the BBC. So that means, a lot of more companies competing for a restrained pool of revenues. The far right has also said it was considering nationalizing motorways. So, concessions operators are under pressure. Banks, obviously, you said there's big stress on the French national debt, the sovereign debt. So you probably want to be away from that. You want to be away from companies that have a lot of debt because borrowing costs will likely increase. You want to stay away from utilities. You want to stay away from a lot of companies, basically.
So all of it, Julian?
That's a really long list, Julian.
There's a long list, and there's no... What strikes me the most is that across all the notes and the research and when you talk to traders or investors, there's not a lot of bargain hunting going on. It's more like damage control. How do I limit the damage? What is the safest bet? But no one is like betting on a rebound or like a great opportunity. It's really about, how do you minimize your risk?
And is that, once we get certainty, does that change? Is this about uncertainty, or is it just we now think that the rally's going to win?
It's going to get worse.
Okay, so that seems to be the tone, is it? That it gets worse, not better?
Well, there's no path for victory for the centrist party. So you're in the unknown. France has never been ruled by the far right unless, you go back to the Second World War. We absolutely don't know what's going to happen. Will there be a hung parliament, a technical parliament? Will the far right have an absolute majority? Will it be like Meloni in Italy? Will it be like, a lot of fuss about nothing and things will remain more or less the same? It's really hard to tell. But there's no, hope of a big rebound come July 8th.
The only thing I hear is that we don't know who the next French finance minister could be. And if that French finance minister is perceived as having credibility, that may be something that the market can look to and see as a positive. again, you talk to a lot of people. Are people talking about who that person could be? And could that be the person that maybe actually does provide some stability for the equity market?
Again, that would be like damage control if they could, pull out someone with a lot of credibility. Because when you talk to strategists, when they look at the French debt, they don't expect the spread with Germany to go back to where it was. It will be higher. There will be a higher discount on the French sovereign debt. So even if you find someone that has some credibility, it's about damage control. I don't see how in a month or so, their investors, foreign investors, Japanese investor will suddenly buy French debt.
Julian, it's going to be an interesting week. You guys are going to be busy. Damage control, that seems to be the tone that's come out of this conversation. Julian Pontus, Bloomberg's French equity market reporter, thank you very much indeed. Let's talk a little bit about what's happening here in the UK. It almost appears as if we're forgetting the fact that the UK is also likely to go to the polls. It is going to go to the polls. It is likely that we are going to get a Labour Party government. What does business want out of this? Well, we're going to try and find out today. Bloomberg is having a live televised debate. It's happening at 12:30 p.m. UK time. Anna is going to be moderating. Kimi Badenock from the Conservative Party, the Labour's Jonathan Reynolds, Labour Party's Jonathan Reynolds on the other side. You can watch it. We've got it live on Bloomberg TV. Globally, you can catch it, of course, on the terminal, the website, YouTube, etc., etc. Sam Munstead joins us now to kind of give us a little bit of a preview. What does British business want out of this election?
Stability. I think right now, because ultimately the picture for whoever comes in, and at the moment it looks very much like that's going to be a Labour government, it's not that good. The fiscal picture isn't that good. How much they can do, it's going to be mostly kind of tinkering around the edges, trying to improve where they can. But certainly for that first year in power, and we've got a nice story actually over the weekend on the terminal, you're going to be inheriting an economy that's not in particularly good shape. It's okay, but it's not in particularly good shape. And then you've got a picture beyond that unemployment is starting to tick up a little bit. You're going to have a lot of people in the country are not enormously happy, and they're going to have to try to keep them all on board.
Well, Guy mentioned that it's largely expected that it's going to be a Labour victory. Of course, to be frank, anything can change, and until the very last minute, we know that in terms of elections. We pay a lot of attention to the two largest parties. Let's talk a little bit about the Scottish National Party, the Lib Dems. To what extent does that affect policy?
So I think within this election cycle in particular, so Reform are obviously having an influence on the Conservative Party, right? However, at the moment, as you sort of just mentioned, Labour are way ahead in the polls. So from a business perspective and from a markets perspective as well, that's kind of all things that are bubbling in the background, right? At the moment, the main focus is on and now we're actually, earlier than you might anticipate, getting into the real details of what Labour's policy may be on business, on green energy, on, more broadly on the fiscal picture.
So we actually want some details.
Yes.
The Labour Party has said it doesn't want to raise taxes. What it wants to do is grow the perimeter of the economy, make the economy bigger. If it struggles to do that, how far are we from them talking about the Europe question? Because one of the easy ways you could argue to grow the economy would simply be to change the relationship with Europe, assuming that Europe would be willing to do that.
Yeah.
Let's assume as well that they want two terms. How far into... is there an expectation from business that this is going to be something that changes in a significant way?
I think there's an increasing expectation that it will become part of the conversation, maybe even within that first year. So as we've gone through the campaign, there's been lots of commentators around saying, why isn't it being talked about more? And the Liberal Democrats were the ones who really started to push it a little bit further. And now Labour have addressed the question a bit, but very carefully, as you might expect, because they're still within the campaign. I would think within the first year or so, that will start to be a question that's asked more and more, especially if, as you're kind of mentioning there, the economy continues to kind of bump along at quite a stagnant pace.
Can we talk about the market reaction here? I think you're the perfect person to do that with. How do you trade this? Is there positioning that's being built around this right now?
Yeah, I mean, actually, something that was interesting is that, so it was what you guys were just talking about, the French elections, and when that happened and we got this big sell-off, all of a sudden there were lots of strategists saying, oh, now the UK looks quite solid, right? Because it's kind of boring is beautiful.
Relative to France.
Yeah. But the flip side of boring is beautiful is that there aren't that many catalysts. So actually, the UK got a little bit of a boost, from people saying, OK, maybe we'll put our money there because things are looking a little bit less stable in France. But there aren't that many catalysts to push it on. So actually, in the intervening couple of weeks, everything's been quite staid. So the real catalyst remains, beyond the politics picture, the Bank of England and when rates are going to change, and that is going to remain far more important, I think, than policy, certainly in the near term.
How quickly do you think the Bank of England is going to have an impact, I guess, is the other question. And again, this comes back to how quickly does the Labour Party start to feel the effects of a better economy, I guess is the question that I'm really asking. Policy is likely to still be restrictive.
Yeah.
It's just not going to be hitting the economy, therefore, as hard. So is there an expectation that the economy, once we see rate cuts coming through, will start to pick up materially? Because if it doesn't, again, Labour's got to answer that question about how do we get this thing going.
Yeah, I don't think there's any expectation that, as you say, it will pick up materially. So we just had the last meeting. We're going into that meeting thinking, in all honesty, it was going to be one of the dullest Bank of England meetings for some time. I would say it probably was still one for the Bank of England nerds out there, like us on markets today. But it sort of points very clearly to August, right? But as you mentioned, cutting from 5.25% to 5%, still very much in restrictive territory. Maybe you get a little bit of a boost, the housing market, maybe, but it's not going to have a huge amount of impact, right? And everything at the moment is still kind of bumping along at quite a kind of slow pace.
We had a guest on today who, for the second time in the last couple of weeks, has said there may be a safe haven story in the pound. Would you agree with that? It wasn't too long ago. I'm old enough to remember that it wasn't too long ago where, don't look at me like that, that when it was being compared dramatically, obviously, to an emerging market currency.
Yeah.
And now it's a safe haven?
I'd say that's a push. Yeah. I think it looks safer than it used to, but that's partly because of the political story in Europe, political story in the US as you go through the rest of the year. I think calling it a full-on safe haven might be a little bit of a push just now.
Yes.
But, you do have a policy picture politically which is looking fairly flat. The Bank of England is likely to sort of cut rates, but not enormously over the course of the year. So it's fairly calm.
So a relative safe haven in a sea of worry.
An emerging safe haven.
An emerging safe haven. If you take anything away from our show, that's what you need to know. Sam Munstead from our Markets Today blog, we thank you so much walking us through all things UK, from the politics to the market read-through. Of course, don't miss our interview with former UK Chancellor Philip Hammond. He will be joining the Pulse in just a few minutes. Guy, we're talking a lot about the election, the political turmoil as well. There's a couple of other things going on this week. Paris Fashion Week, which I'm sure you're very attuned to.
I am.
For me, it's the U.S. debate. That's what I care about.
We're going to talk about French fashion tomorrow.
We will, I'm sure.
I'm going to make sure.
Okay. Guy's going to dress fashionably and talk fashionably tomorrow as well. We've got the debate, of course, on Thursday out of the States. We've got the data coming in on Friday. There's a lot to digest.
Riksbank as well on the agenda too. Can't ignore that. Lots of Fed speak, lots of ECB speak this week as well. So that may set the tone as well. As Kriti says, it is the Pulse next. Tom will be guiding you through that. Philip Hammond will be joining him. This is Bloomberg.